The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, December 8th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you're with us for this last broadcast of 2022. We're going to look back at 2022, and we're going to look ahead to 2023. That's my present to you tonight. How about that? Those of you that have been watching the program know we cover a variety of topics, all of it pointing to the way we manage money for those of you that are clients and how we manage money for those of you that are listeners and observers and just want to see what a professional portfolio manager's life is like and how we make our decisions. We're glad to have both of you online tonight, both types of listeners online tonight, okay? If you're new to the program, please subscribe to us on YouTube. Click the little bell and you'll get updates whenever we go live. I also would recommend that you follow me on Twitter or Facebook or LinkedIn. I tweet to those three platforms every single day, sometimes more than once when things get really busy. And our next program, if you want to mark it for next year, is Thursday, January 12th. We'll be looking at how the year is starting off and did we have a Santa Claus rally into the end of the year? We'll know by that time, all right? 2022, let's face it, it's a year many of us would like to forget. It's been a bear market since January 4th. This is December 8th, so that's just about a year. It's probably going to take more than January 4th, 2023 to get us back to new lifetime highs. Unless we have a miracle finish this year, we're going to finish negative for the year, making it the longest bear market since 2008. Not the deepest, but the longest. And we're going to look at the various things that happen to make this year so dour. But the most important too, obviously inflation and interest rates. But despite this 2-month rally, the S&P still remains down 17% year to date. S&P is on track, as I said earlier, to be the worst annual return since 2008, the year of the global financial crisis. As you probably remember, 2009 also started badly, and then March 9th, 2009, 676.53 in the S&P 500 turned around and began what was going to turn out to be this current secular bull market, okay? So I think that that is still in the cards. I think that that is the likely outcome. I shouldn't say in the cards because that implies chance, but nothing is certain in what we do. But I have seen plenty of signs, even though it's lingering longer than I'd like, this cyclical bear market eventually will give way, returning to the secular bull market, okay? The two catalysts, as I just said, interest rates and inflation, but really it's all about inflation because there's no need to raise interest rates if you don't have inflation. When the previous administration left office, you guys have heard me say this all year long, it was 1.7% inflation. Currently, we're clocking in about 8.4. That's in less than 2 years. You figure it out and what caused it, okay? So as your portfolio manager, here are some beliefs. The U.S. is in a stronger position to recover in 2023, more so than the rest of the world, and that's because our currency is very strong. Even though it's given back some since the highs of mid-October, the U.S. dollar is still very strong, which is going to attract money coming into the U.S. seeking safety and security. Already this week, the very largest brokerage firms in America are reporting that their wealthiest clients are loading up on treasuries. Now, they would not be doing that. They would not be doing that if they thought inflation was going to be here for a long, long time, as opposed to hitting that crest and turning over. I'm going to show you that data later in the program, and you can make up your mind. But we would be the ones that lead the world out of a recession. I don't think we're in one now. I do think we will avoid a recession. That'll be my forecast in a few more slides, all right? So looking at the sector performances, and I've added one here, so I've separated consumer discretionary and retail. Only 3 were up and only 1 significantly, and that's energy. If I'm perfectly candid and honest, we did not see that early enough in the year. We now have plenty of energy holdings, but it took a while. And our favorite sectors, consumer discretionary and technology, are the ones that have had the worst time, which is why we have struggled this year. It does not surprise me. We had 3 very strong years, 2019, 20, 2021. All right, and then 2022, obviously this year has been a down year, but 3 strong years. The middle of those, 2020, we had a 63% return in our CG capital growth program. So we were due for a pause, but I assure you we have adjusted our trading methodologies, and I'll talk more about that in the January show and what I have done to essentially align our methodologies to the current market environment. You can't just keep going out there every day. If the pitcher's pitching a different pitch, you've got to figure out how to hit it, okay? So this is a chart you guys see all the time, and I'm just showing you in the yellow highlights, so lean in. I do this from time to time. Lean in and look at that, okay? That's the whole year so far. Now you can clearly see over 100 years, we are in very much a bull market cycle. The red on the screen indicates the secular bear markets, okay? And the blue lines in between, the black lines with the blue on top of them, are the secular bull markets, in which we still are. What we have done, it's taken the entire year, and I know it feels like an eternity, but it's just that little piece of yellow there. We have pulled back from overbought conditions, and we are now resting on that trend line. If you look really carefully, you can see we're right there. Okay, and that's why the market has done really very little here over these last 2 months. It's corrected off its extreme lows. We'll see how it finishes the year. Seasonally, November and December are the best 2 months of the year. April is third strongest. Okay, biggest stock market crashes in history. You'll see 2022 is not even on here. The depth of this bear market has not been what has caused us the pain. It is the length of this bear market. So 2020, the pandemic, you can see the coronavirus crash is how it's labeled, lasted 5 weeks. You can endure almost anything. Think of the dentist office when that drill's coming down. You know it's not going to take, a day or an hour, right? Okay, in this case, this bear market has taken the entire year so far, and there's more to go, probably for another month or so. All right? I'm not sure of that, but we'll see. I hope we finish strong into the end of the year for the reasons I just mentioned. But the depth of this bear market has not been what's hurt. It's been the length of it, all right? As we finish up, you guys know that this particular slide talks about what percentage of the current earnings reports are beating estimates. 71%. The historical average is 73%, so we're a little bit below that. However, look at all the things that are going against the market, and yet still corporations, for the most part, are doing pretty well. We have industrial 79%, technology 80%. Even though the technology sector, as I showed you a few slides ago, has underperformed, this current quarter, it's getting back on track. And that's what Wall Street likes to see as we move forward. Remember, Wall Street is always looking 3 to 6, sometimes 9 months ahead in how they're purchasing and what their expectations are on stock market performance. Okay? For 2023, now I'm going to go through this fairly quickly because there's a lot of data here, but feel free to play back the video if you really want to see what my mindset is on this. In 2023, I expect a further significant decline in job openings. That means the number of jobs that are available. At some point this year, earlier, there were 2 jobs open for every 1 person seeking a job. All right. And that's part of the just crazy demand and lack of supply issue that has caused this inflation. But I expect that those two coupled with a 0.5 to 0.75%, not even 1% increase in unemployment, and that's going to shrink the jobs workers gap. Okay. Here's the challenge. Number 2, keeping the adjustment process on track. It's going to ensure the U.S. GDP growth remains below its potential. Now that seems crazy, but that's what's needed. You're going to see that phrase, that sentence in more places in my 10 points here. We actually have to force the economy to gear back. Okay. The critical macroeconomic question of 2023 will be whether inflationary overheating can be reversed without a recession. My analysis suggests that the answer is yes. I am in the camp that does not expect a significant recession. If it does, it'll dip down with 2 negative quarters and then immediately turn back to positive growth. That is my forecast. I expect another year of below potential growth. Now, that's kind of a little trick phrase there, but below potential growth and the labor market rebalancing, in other words, retargeting itself to find and fit the available jobs to solve much but not all of the underlying relentless inflation problems. And inflation has been relentless. I was in the camp that thought it was transitory. That has not been the case. All inflation is ultimately transitory because we do not live in high inflationary environments for very long compared to stable inflationary environments. Okay, and we'll see charts on that later too. So the large tightening in financial conditions engineered by the Fed, and obviously the Fed has really kicked up its tightening here, should keep GDP growth near 1%. That is positive. I would definitely, and I'm sure you would too, prefer 1% growth rather than any negative growth. It's not bad. Think of this as buying a Maserati, going out there on the roads in Montana or Wyoming, revving it up to 180 on those highways. I am not endorsing that particular activity. But then having to rev it back so that the engine doesn't overheat because you've been driving at 150 for an hour or 2 hours or whatever. And I don't know much about Maserati, so maybe you could take that. But my point is, and I think you'll get it, that there are just certain times in our lives when things we're doing or entities with which we're working, we have to cool down, all right? So next, point 6, the economy requires softer, not stronger, softer GDP growth to further reduce labor demand, as crazy as that sounds. I told you we'd use that phrase again. The third step requires labor market rebalancing to then slow wage growth, okay? Follow that now. Reduce labor demand is second. Third step is reducing, and I should say slowing wage growth. So these sound negative, but they're not, because it's what we need to do to slow inflation without turning growth negative. You turn growth negative for 2 quarters, it becomes a recession. All right. The fourth step requires that softer wage growth brings inflation back to the Fed's 2% target. Some inflation is good. If we were even at 3.5 or 4, people would be really happy right now. But when it was ramping up from 2 to 4, we thought that was going to be it. And of course, no, it wasn't. It more than doubled from there. I expect the Fed to slow the pace of rate hikes, and we have a Fed section coming up. For those of you that haven't watched the show, hang around for that, as it shifts to fine-tuning the economy to keep growth below its potential. And again, I know that's crazy. Why are we trying to reduce the potential? Because we are the strongest economy in the world. We have been since before World War II. We continue to be. I know the Chinese want to think that they're our peers. They are not. And that's a whole topic for another time. I will cover that in 2023 in a special section. Okay, my bottom line, 2023 will not have a recession. It will be below potential growth. So there will be what's called a governor on the growth. So, school buses, you may not know this, but school buses have a governor on the gas pedal because they don't want a rogue bus driver getting in there and cranking the bus up to 80 or 90 miles an hour and injuring children. So there's a limit to how fast school buses can go. And that's exactly what the Fed's trying to do. They want to keep the economy growing, but they want to limit it to put a lid on inflation, to drag it down. That's so important because when the market perceives inflation is truly under control, the stock market will go crazy to the upside. That's my belief. Okay. I have never shared this with you. So why has this year felt so difficult? And again, it's not the depth of the bear market, it's the width. So people's neurological responses or emotions, let's face it, emotions regarding financial outcomes mimic cocaine and mortal danger. This is my assessment, okay? The fear of loss will always, always, always exceed the hope of favorable results because the market goes up on a stairway and down in an elevator. It is much more emotionally swinging and injurious to us when the market's going down. When things look dire, the brain responds with the flee mentality, the same way a brain activity tells someone when you're being chased by a 750-pound grizzly bear, you need to get out of there. But when the tide is in the right direction, financial gain has the same chemical response as a person on cocaine. I did not do that study, okay? But that's the research I found. This is behavioral finance in a nutshell. All right, before I go into inflation, I'm going to take a sip of water here. I should tell you that I'm kind of nursing a cold. If I have a coughing fit, I'll mute the mic, or at least try to mute the mic, and try not to blow you away with that. So, hey, Deb, how are you from South Dakota? And, okay, we have a Serge. Welcome to the show. Any questions, anybody? Thanks for the Merry Christmas, Charles. I see we got about, 6 or 7 states here so far. That's great, guys. All right, so inflation, probably the favorite topic of the year in a negative way. So let's look at the data from New York University and S&P returns. Okay, so this is all positive, right? So when we have rising inflation, our annualized returns, rather than being around 9.2%, which is what it has been average since 1950, drops to 5.5. It doesn't turn negative, 5.5. But during falling inflation, 14.7. So that exceeds the annualized returns from 1950 to 2021. We don't know 2022 yet. Rising rates and falling rates are about the same, 9.7, 9.6. But clearly markets like falling inflation, which is why I said about 5 minutes ago, when the big players, the deep pockets on Wall Street sense that inflation is for real falling, you're going to see people pouring into equities because it's less risky. It's all about maintaining risk and understanding risk and managing risk, okay? So the key inflation gauge shows that price increases slowed in October. If you lean in again, remember the yellow a little bit earlier, lean in again, and you see the red just a tiny bit below there. The survey was 0.4. The actual number was 0.3 month over month. You can see the huge bars I was dealing with when we first were doing this show earlier this year. 1% month over month, that's annualized 12%. Obviously, if that had stayed in place, thank goodness it did not do so. We're pulling back from highs. Food prices in the U.S. should be substantially lower in 2023, And that's a positive. Why? The CRP index, which is the black line, has already retreated, even though consumer price index food is still rising. But you can see that little bitty downturn up there. So that's going to get in sync and drive lower too. On the employment scenario, now here's where there's mixed data. Excuse me. I think this is kind of odd. This has been the most mixed data employment report, which is November now, because if you remember, we do this on the second Thursday so that I can comment on the previous Friday's non-farm payroll. Whoops, wrong way. All right, so LinkedIn is saying that the pace of hiring is quickly deteriorating. That's the first time I've used LinkedIn data, but it's getting to be a pretty good source because there's so many people actually job searching there. So the current year you can see dwindling down. The previous year was going up. There's usually hiring that goes on pretty actively at the end of the year so that corporations are properly staffed for the beginning of the next year, but that's not happening this year. And yet, non-farm payroll survey for 200,000, actual 263,000. So it was still positive, although less than October, but still quite positive. There's nothing here. You have to go all the way back to 2020 to see a negative payroll report. So this is positive. Okay, unemployment rate is flat. You see the little line there with a red dot on it. I put it there for you. So the survey was 3.7. The actual was 3.7. This is a pretty good number, okay, 3.7 with the inflation rate going the way it is and with all the talk of recession. Private hiring increased by only 127,000. That's hiring by the private sector as opposed to government sector. Well below the estimate, but still positive. Okay, still positive, all right. The labor shortfall, about 3.5 million. Now, if you remember back to my projections, I think that the Fed's work is going to tighten these two lines. So I think the number of job openings is going to shrink. The supply of workers is going to stay about the same, but these two lines are going to come back together and essentially where supply will meet demand. And that's going to be a healthy thing because it's going to reduce inflation. People were paying crazy prices for houses just 6 months ago. That is not the case now. You had to drive out of state, in my case, to find a car you wanted to buy. That's not the case now. You had to pay up to get workers, and now we're seeing layoffs, okay, and less hiring for sure. So the average hourly earnings, this isn't the actual number of people hiring, but the actual earnings, the survey was 0.3, the actual number 0.6. So that's still increasing. The Fed wants to see this drop. Now, it's not that like the Fed wants to see you not make as much money, but if wages keep rising, then that's the biggest driver of inflation right there. It's not cars, it's not houses. Let's face it, the biggest component is when all the salaries of America increase. That creates inflation. And that's when people who produce goods for those people say, we've got to raise prices or we're going to lose here. Okay? The labor market demand has not broken. It's down slightly from its peak. You can see the little black line just curving down there, but we are still quite strong on the labor market, even though we are below pre-COVID levels. You see the little dotted line I put there where we would have continued for the payroll employment. We obviously had just dropped crazy 22 million in January, February through June of 2020, which is the pandemic, and it's been recovering ever since then on a pretty steady line. All right. So I'm encouraged about the employment situation. It's a little bit of the contradictory data there, but considering everything that's going on, pretty strong. So the reason we talk about politics is because politics determines policy, and policy has portfolio impact as well as personal impact. Say that real fast if you can with all those P's. We haven't talked about Ukraine, but this, of course, affects so many people around the globe in a material way, but I think, from the investing side, which is what this program is, it affects them psychologically. So more and more of this map is turning orange and red, and that means that's what Russia is controlling. And yet Ukraine has reclaimed half of that territory that they lost in February, and President Vladimir Zelensky, who is Time Magazine's Man of the Year, is planning to keep pushing the Russians on the battlefield. And he says working on global diplomacy, but he will never accept ceding any land to Russia. On the battlefield, they have stolen Russian, and I'm sorry to be laughing, but it's just, this is a little country compared to the mammoth size of Russia, who was our partner that defeated Germany in World War II. And they are putting up a mighty battle. It's not quite David and Goliath, but it's pretty close. Okay? They've been using inexpensive technology and drones to target their adversaries. This war is nowhere near done. It stayed out of the news for a while, and until some big bomb drops or, God forbid, a nuclear attack happens. But it's hanging out there, and it affects, again, many, many people, and they become refugees, and it's just a terrible situation. But since this is a financial program, I just have to say that it does affect consumer sentiment because it creates uncertainty and unease in the markets. So politically, this is the change. Now, you might be saying, that's wrong data, Charlie. It's 51 Democrat, 49 GOP. It's actually not. The Republicans lost one seat. The Democrats gained a seat at 49. And there are 2 independents. The guy in Maine, and then, of course, the infamous Bernie Sanders. When you say independent in the United States, that means socialist, okay? And if you add those 2 independents, i.e. socialists, that's how we get the current blend of 51 Democrats and 49 GOP. So a loss for the GOP for sure. Now, the GOP did pick up 9 seats. Democrats lost 9 seats, but basically they just flip-flopped because the Dems controlled the House just by 4 votes, and now the Republicans control it by 4 votes. Virtually no one expected this outcome. And you can see most of the country is red, but the blue areas are highly, highly populated, and that's what swings the election. In states, actually the Republicans, let me go back here. In states, you know what? Did I have the wrong slide? Let me go. There we go. 221, 213. But let's look at the governor's races. So the GOP lost 2 seats, and the Democrats picked up 2 seats. There's still more seats held by the GOP, but only by 1. I mean, an absolute split would be 25 and 25. So in general, it was not a good cycle for the Republicans. That may be good or maybe not be good for the markets. I think I've said before, I showed you in last month's program, divided government has historically been very good for the markets, considerably better than control by either party. So that's what we're going to have for 2 years, and we'll circle back here in about 18 months and see where it looks like we're going to be in 2024. When I cover the economic indicators, I'm looking forward at data that's looking backwards. Okay, so why do I have the projections that I do for 2023? I'm looking at retail sales, and if you don't want to drill in and look at all of the data on the screen, just read the captions at the top, okay? So retail sales topped expectations, suggesting that consumers are willing to spend, all right? So they're not really concerned about the surge in prices and inflation, which is good. We need resilient spenders, okay? We need resilient spenders. I got 2 questions here in the chat box. How does the new 2023 Congress with the Dems having the White House and the Senate House affect the market? So good question from Keith. I kind of covered that a few moments ago, but I really in depth covered it last month. So go back and watch last month's political segment where I showed the data since 1950 under 3 scenarios. When it's all Dems, so White House, House of Representatives and Senate, all Republicans, or when it's split government. And split government is far and away, the most successful time for the market, because the market doesn't have to worry about any crazy legislation either way that can affect the natural buy-in, supply and demand cycle. So go back and watch that section if you want. Good question, Keith. Thank you. Is the U.S. note now back on the gold standard? I must have missed that, Charles. I don't think we're on the gold standard at all. We have way too much debt to do that. So if you've got some data for me on that, let me know. But it certainly flew under the radar as far as news goes, if that's the case. I think we are a long way from ever returning to the gold standard. It certainly would be good for the I guess, responsibility of our politicians, because they couldn't just spend like crazy. They would have to only be able to spend, or, certainly the money in the treasury would have to be backed by the amount of gold that we have. And since gold is a finite entity, probably not going to happen anytime soon. So personal savings rate dropping. Good questions, guys. Thank you for that. Keep them coming. Dropping. Okay, so we saw it spike during the pandemic. The reason for this is because of all the giveaways that the government was doing, right? Okay, so here's a pandemic check, under Donald Trump. Here's a second one under Donald Trump. Here's one under Joe Biden. And then after a while, when things slowed down, people paid off debt, then they stopped savings. And so now we're at nearly a 60-year low in the personal savings rate. Not good. This doesn't have to be super strong, because if people are saving like crazy, then they're not spending. If they're not spending, then the economy's not growing as much, because, as you know, the astute listener to this program, 68% of our GDP, there are only three components of GDP, so that's consumer spending, government spending, and corporate spending. 68% is consumer spending. So at some point, when the savings run out and their earnings aren't increasing, and the Fed's goal is for that not to happen for a while, to tame inflation, then at some point that's going to slow the economy. If it slows the economy, we've learned tonight, it's okay. Just don't turn it negative, okay? Slow growth, good thing for 23. Really, 1%, 1.25%, 1.5% solid growth, 2023, that's success if we're here a year from tonight talking about that. So U.S. personal consumption expenditures continuing to rise. That's the straight line. Without COVID, it's exceeded that last year. You can see it bump above the blue line there. So personal consumption still strong. Personal savings as a percentage of disposable income continuing to drop. This is sort of a companion slide to the one earlier. This is not going to change until wages rise or people spend less, both of which would slow down the economy. So we'll see which of the two it is. My guess is people are going to continue to spend even if they rack up credit, okay? Credit card debt, I led right into that. All right, as a share of personal disposable income continues to rise. It dropped way down 2020, but now it's on the rise again. It's been much, much higher than this. Look back to 2008, 2009. People they have a deficit lifestyle. Most people do. I do not recommend that, but they want their stuff. And that's one thing that drives the American economy and why companies make more widgets every year, because they're satisfying the demand. How people pay for those is not the corporation's business. Personal responsibility must take hold here. All right. So household excess savings likely to be gone. There's a lot going on the screen, but the takeaway on this is the savings rate trend assumes a decline at the 2022 rate. So this is going to be going down. This is just a more graphic way to show what I suggested earlier, that at some point, if there are no more savings, people are going to stop spending, or they're going to put it more on their credit card. And when they max out their credit cards, then there's only so much they can do. So then they're precariously living at the edge, which I hope people don't do. Certainly no one on this call. Okay, I'm going to take another break here. Have I missed anything? I think I answered those two questions. All right. So the Fed definitely in the news this year with all their rate. Look at the red lines. The Fed, oh gosh, the most aggressive tightening in 40 years, okay? And it has weighed on the markets, and it has weighed on the economy, because we don't know what the Fed's going to do. Now, we think that they're going to be reducing rate hikes, okay? So he's saying going to be smaller rate hikes, going to start in December with that. I think that's likely. This is the chart of the expected rate changes. Okay, so we're seeing increases and then incremental in the dark blue there. So once we get into 2023, that likely will become a reduction, actually cutting rates halfway through. So the Fed doesn't just ramp it up to 5.5 and leave it there for years, because they know it's stunting growth. They're trying to put the brakes on, not go negative, right? That's what we've learned tonight. But to put the brakes on, to give us that 1.25% growth, all right, so that they can comfortably cut rates and not have people go hog wild, because at that point, people will have a little bit of deer in the headlights wondering, what's the Fed going to do now? So question, do I see a positive stock market reform in 2023 in addressing naked short selling of stocks? I just don't see that as an SEC priority. I realize that there and some viewers on the show, Charles, aren't going to know really what that is. But very briefly, because I know you've mentioned this before, one of the reasons why we have the most liquid stock market in the world is because long ago, you can buy a stock and sell it higher. That's what everyone wants to do, buy low, sell high. But you don't necessarily have to do it in that order. You can sell high and buy low and still make a profit. Well, how can you sell something that you don't own? I actually had a short selling segment last year. I'd have to go back and find the issue. If you have a question on what short selling is, call me or cb3@cb3.com. I don't see this really being addressed by the SEC this year, simply because it's not a prevalent problem. Right now, the retail trader has been pretty much scared away from the market. The whole meme stock issue, which was just out of hand a year ago, has dwindled, and I don't see it. There's much more concern about regulation in the crypto space, obviously, with the FTX collapse. So that's my 2 cents. I could be wrong on that, but let's keep watching it, okay? So market price for Fed funds rate change, kind of a gobbledygook slide here, but basically it's marking time. So the market obviously predicts where they think the Fed is going to go, and they invest accordingly. We're treading water because it looks like the Fed's tightening cycle is coming to an end. And believe me, a lot of us want to see that, because when you have a Fed funds rate that's approaching 5.5%, and it could easily get to that point, all the other interest rates climb with that. And it affects housing, which we'll talk about in just a few slides. And so the Fed, we really want to, get to the pain point here and say, okay, uncle, enough. All right. Speaking of housing, so new home sales actually unexpectedly climbed in October, and I'm glad to see this. So that's the dark blue line. You can see previous years. Normally, sales climb into the end of the year. I'm not really sure why, because you'd think that would be more like in the spring or even in the summer, people moving and getting in place for a new job, for a new school year. But we did see a little bit of an uptick in October, and that is a positive, especially because interest rates are so high. If people are still willing to buy with a 30-year mortgage, I got a quote here for this last week just so I could talk about the show. On the show, 6 3/8 is about what they're quoting right now. It reached as high as 7.25. So private construction spending, obviously still meteoric, and yet it's pulled back a little bit. Non-residential, the blue line, i.e. commercial, pretty much stilted, and it's been that way for some time. I mean, there is commercial building going on here in Nashville, but not nearly at the breakneck pace that, say, the leisure industry, meaning huge towers for hotels and condos, okay? As far as office buildings, no, because the work dynamic in America and across the world has changed. Work from home, WFH, is still very much in play, even though you still hear some of these New York brokerage firms saying, nope, you got to come back to work. Well, they're finding that there's a lot of pushback on that. So I don't see that blue line ticking up anytime soon. The surge in mortgage rates suggests that home prices will see year-over-year declines. That's happened, but we're again starting to see that push up. Remember those 2 slides ago, we talked about October home sales rising. What we want to see are new homes being built and the demand still there. I think you're going to see that as we get into the first quarter, and of course, March, April, May, even June, the busiest months for the residential housing market. We are to the point now where if you are tired of being in your house and you want to go rent, it is less expensive than at any time in the last 20 years to rent versus owning a home. This is a great chart. More expensive to rent is the light blue. More expensive, pardon me, to own, more expensive to rent is the purple. Okay, so we are definitely in a spiking area here. Mortgage costs, home costs are higher than rental costs. Again, if you're thinking of moving and not buying, this would be a good time to do it. So, all right, that's pretty much what I have for you tonight. However, got one last short video for you here. We're going to have our next show, as I already told you, this January 12th. This has been a tough year, guys. I know it has been for you, and it has been for me. The video I'm going to show you is actually about losing, and more losing, and still more losing. And yet it's a video about courage. I've shown this before. I think it's going to be a tradition now here at Christmas, and it's especially appropriate this year because of the difficulty in 2022. This particular video has a special meaning to me, which I think will become understandable when you watch it. But I hope that you're encouraged by it. I hope you realize that tenacity, sticking with something, can never be underestimated as a human quality. Indeed, sometimes winning takes longer than we would like to see. When you have a bear market that starts on January 4th, it's tough. And I get it, guys. I'm right there with you. Those of you that are clients know that I invest alongside my clients in every program that we have. But look at this scene here and just think, we still have lots of blessings. We have lots of good things, and I do believe the best is yet to come. And rather than end with Timothy, I want to end with Romans 15 tonight. May the God of hope fill you with all joy and peace. And I pause there just because I know it's tough. But may the God of hope fill you with all joy and peace as you trust him in 2023. I want to thank you guys for watching this year, for those of you that are clients, for those of you that are viewers and just love the program. I hope you love the program. Pass it on to your friends. We have optimism here. I believe 2023 is going to be a solid year. I believe that we will get an end to these rejections to the new highs, and eventually we'll push through to new highs because this economy is strong, this country is strong. Despite the fractious nature of a divided blue and red people in this country, we still have a great love for what is the greatest country in the history of the world. For your financial peace of mind, CB3 is beside you all the way. It doesn't just matter to me. It matters to those, Alice, and the other people who work with us, that you guys get the education that you need when you watch these programs. If you have anything that you'd like us to change, to add for 2023, let us know, okay? Because at CB3 Financial Group, we don't just manage your assets. We become one of them. Merry Christmas, Happy New Year, and I'll see you next year.